John, good morning.
Morning.
I don't have your image, but I don't have to.
All right.
Yeah. Well, you need my image because you need it to be able to see the PowerPoint slides and so on. Did you see an email from me this morning?
About the chapter 3 files?
Yeah.
Yeah, I did.
Good man.
Got it.
In the past, I had built that into the chapter 9 slides, and I didn't this time for some reason, but that's okay.
Okay. I was wondering, I thought we already had covered that chapter.
No, we skipped it. I tell you what.
Okay, that's right.
Okay. You know, I had some joint replacement surgery over the holidays.
Yeah.
Got a hoarse voice. And my dean and Chris Smith covered for me. And they were supposed to cover that chapter. And I got mixed messages on whether or not they did. And I don't normally cover it until I hit chapter 9 for reasons you will see today. But there's nothing wrong with your memory. Theoretically, it was supposed to have already been covered.
Yeah, I remember that now.
How you doing?
I'm good. Mostly just been hunting, keeping away from people.
Yeah, good for you. We're hermits.
Yeah.
We're exploring ways to order stuff and been doing it all our lives, but I saw one authoritative source that said if you get a cardboard box package from Amazon or whatever, he said it's good to take it and stick it somewhere for 3 days.
Yeah, I've heard about that.
So we've been doing that. We get them. I've got fireplace forceps, these big. So I pick it up at a distance, stick it in the garage, and we start our little 3-day calendar.
Yeah, they said cardboard doesn't hold it quite as long, thankfully, as some of the other ones for 3 days will do it.
I saw said that it can live on cardboard 24 hours.
Yeah, that's what I saw.
But this guy was saying be extra safe, and if it's not perishable, then why not?
Yeah. I heard Amazon wasn't shipping any more orders till April.
Really?
Yeah. Which I mean, April isn't like tomorrow, but
right.
But that was like I first heard that like a week ago.
Well,
it seems to be true so far because I haven't got my shipment.
Well, we have gotten a package every day for the last 3 days, so I'm not sure that claim was accurate.
Guess not.
Strange times.
Yeah, that's for sure. Dad's been bringing in groceries and stuff and wiping everything, like wiping the milk handles down and everything.
Yeah, good idea.
Taking the shoes off at the door.
A few weeks ago, we got a freezer, little chest freezer to stick in the extra room, filled it up with frozen foods. And then we learned that hey, Vicki, good morning. Then we learned that the virus can survive frozen indefinitely. So, I mean, I think we loaded it up early enough. It was before it was widespread anyway, but when we get stuff out of the freezer, we wipe it off now with, I got these sanitizing, these wipes that are, in fact, the very first thing I ordered was a big box of these 99.99% of the germs, 65% alcohol, 1,000 individual wipes, just.
Yeah. Yeah, know anybody that's gotten it?
Nope. thankfully, so far.
Yep. My
Guys,
dad knows one guy. He's from Oxford. He got put on a ventilator for it.
that's not
Just
good.
about killed him. Yep. But
Did he
besides that, I
survive?
only know one person.
Did he survive it? Did the ventilator allow him to survive it?
So far, I think they eased up the percentage of the ventilator yesterday. I think is what it was. But I need to check on him, I guess.
That sounds promising.
Yeah, he's probably gonna be all right. But for a couple of days there, they thought it was gonna kill him for sure. Which is weird. I mean, he was a young, healthy guy.
Oh, look. They've, well, you've been reading the news, seeing the news, right? Young people are not as insulated as once thought, not even little kids.
Mm-hmm. They said 38% of which is like a couple weeks ago when I saw this, it might change, but they said 38% of the people in the hospital are between 20 and 50.
Wow.
Yep.
Part of that may be because it's younger people that are not practicing social distancing.
Everybody went to the beach during spring break.
They went to the beach, and in New Orleans is crowded like nobody's business too.
Yep. That's
Big
probably a lot of it.
Good morning. Victoria, do you go by Vicky or Fergie or what?
How about Tori?
Tori, right. I knew it.
He's going to write it down.
I'm writing it down because, I already knew that. I've been calling her that, referring to her. Everything's falling apart, including your prof. By the way, I have a hoarse voice. I'm not coming down with it. No other symptoms. Just, I get it now and then. Did you guys get, I already asked John, did you guys get the chapter 3 slides?
I did.
Yeah.
Perfect. Welcome, Phil. I'm waiting for a few more people to join. I guess you also use the password.
I just clicked on the link and it let me in.
Maybe use it.
Hey, whatever works. I was calling about something else. Yeah. And they suggested 2 additional security measures. One was a password for each meeting. And the other was to lock down the meeting after, 10 minutes or 15 minutes after we start. I don't think I'll fiddle with either one today. Have you been hearing about the Zoom bombing?
Yeah, I heard about it earlier. One of my teachers canceled like some thing we were supposed to do on Zoom because of it.
Really?
Yeah.
Well, Dr. Polly who reads everything, found the New York Times article on it and clipped out the important parts and sent it to us. I don't know if those are pranksters or competitors of Zoom. I guess. Presumably, I've taken measures where that won't happen here. But we'll see. And we'll sure find out if it does.
Yeah, that's true.
are your other professors that are delivering classes online, are they doing it pretty much the way I'm doing it, switching to a whiteboard and writing now and then, and video, maybe some video clips in some classes would be appropriate. It doesn't really fit ours, but
Most of mine are just doing like voiced over PowerPoints, which I know you can't do that with finance because we have to see the problem. But
actually, the recordings, I can do it.
oh, you can?
Every other course I teach 2 of our graduate classes and a senior level undergrad. And I've got voiced over PowerPoint recordings for those. I made those a year or so ago. The material doesn't change that much in this subject, so.
Yeah.
But I had not done it for this class.
I mean, I have 2 people doing it strictly through you submitting it to them by email, which is annoying because I get like 50 emails a day.
I
Oh,
bet.
at least.
So,
Well, I'm trying to find a better way, but in the meantime, I'm hoping this works.
That's pretty good so far. Are you taking attendance on these?
No, I don't require you to attend. The meeting is recorded and then posted to YouTube. I don't know if you guys have been looking at those, but that's
Halfway through last class, I was out of town.
Well, the voiced over PowerPoint doesn't really work well with activated when it's an active room. It's like I say, I've got a ton of them. Carmen and Kamari, good morning.
Good morning, Mr. Todd.
And Robin, I don't think I said good morning to you, but good morning.
Good morning.
And I committed the worst sin you can. I forgot a student's nickname. Won't now. John, good morning. John Edwards, pardon me. I've got more than one John, yeah, in this class. And Hutch, good morning. Tell you what, guys, I've got 10 o'clock. Shall we start? Please forgive my voice. It's kind of hoarse. Okay. We were looking at the dividend model and had almost finished it up. There was one little thing I wanted to do with it involving preferred stock, and you'll see why. Let me move this up where I can get it going. Are you seeing a preferred stock valuation slide? That's not good.
Yeah, I am.
Ah, good. Okay. Okay. You know, preferred stock is just like common stock in that we assume the value of a preferred stock. Trying to get my monitor to respond. It's the present value of all future dividends. And you can use it to value preferred stock. You can use, pardon me, talking in circles. You can use the preferred stock model to value common stock. If you set the growth rate equal to 0, for example, look, here is our common stock model. Our estimate of the value of the stock is a dividend divided by the required rate of return minus the growth rate. Or you can put it in different form to solve for your expected rate of return. Now, we did all of this for common stock last time. For preferred stock, if you buy a share of preferred stock, your dividends never grow. The same dollar amount, they're actually paid quarterly, but we're working with annual dividends year after year after year. So if you want the value for preferred stock, you set that growth rate equal to 0. And you just end up with, I'm sorry about this subscript. Again, sorry. I'm getting cute trying to change colors here. Yeah. It's the dividend on preferred stock divided by the required rate of return on preferred stock. Notice, not only does the growth rate, what one of you guys, a lot of feedback, silence your mic. Thank you. Anyway, not only does the growth rate disappear, the subscript for the time of the dividend disappears because they're all the same. So, for example, if, and also the return in preferred stock. Nah, too many. It's found by just taking the dividend over the price. Again, the growth rate disappears, and so does our time subscript. So, for example, I think in your next slide, you've got energy preferred. If energy preferred stock pays an annual dividend of 8% of its $100 par, and by the way, preferred stock par value can be anything. It's not like bonds, where all bonds have $1,000 par value. So 8% of $100 would be $8. And you divide it by the required rate of return by the preferred stockholders, but you put it in decimal form. If it's 10%, then you put it in as 0.10. And we get the value for the preferred stock of $80. And likewise, what if, trying to leave the equations up there for an example. Okay. What is your expected return on energy preferred? If you buy it for I don't know, $60. Using, that's cute, didn't even mean to do that. Using this formula down here, your expected return. Guys, I'm getting anomalous behavior from my whiteboard that is not supposed to happen. 1 second. I'm going to put on a glove. It's not supposed to react to the touch of my skin, but it is. Look. All I have handy is a clunky garden glove, but we'll see if this works. I can hold in with it. Okay, so, nope. That's glove. It's a softball. All right. Sorry for the glitch, guys. See if we can get this rolling. There. So your return on the preferred, if it's paying $1 dividend of $8 a year and you buy it for 60, then your return would work out to be, I think I'm doing this right, 13.3%. So sometimes you use the preferred stock model to value the stock, and sometimes to figure out your expected rate of return. You with me so far? I need an amen from somebody. Can you hear me out there? Somebody give me a wave at me, something.
Yes.
Okay, thank you. Now, try this one. The share of Con Edison preferred. You know, Energy is a utility company, and so is Con Ed, and those are the companies that sell preferred stock, raise money by selling preferred stock. A share of Con Ed preferred, pays $4 dividend, and investors require a 5% return. Question A, what's the value of the preferred? And B, what is your expected return if you pay, I don't know, I'm just making this up, so this will be way off, $40 per share. Take a second and tell me what you come up with for each of those. What do you guys get for the value of the stock?
I got 80.
I think you're right. It'd be like $4 over 0.05. That would be $80 a share. If you could buy it for a bargain basement price of 40, then your return would be $10%. Did anybody get the 10%, or am I way off base?
That's what I got.
Cool. Guys, that's about it for preferred. Preferred dividends. If you buy shares of Energy Preferred or Con Edison Electric or Western Gas Preferred, it'll pay a constant dollar dividend that never gets bigger. Which means if your salary never got bigger, what would be the growth in your salary, the growth rate? 0. That's why we say that with preferred stock, the growth rate is 0. All right. Any questions on this? Far away, Hampton.
So can this kind of like relate to like inflation and stuff like that?
Most preferred doesn't have any kind of inflation built into it. You build inflation into your required rate of return. If, for instance, in this particular problem out of the slides, if you thought the inflation rate was going to be higher, then you would increase your required return, maybe from 10% to 11. But your inflation premium is always built into your required rate of return. With preferred stock, we call it R sub PS. With common stock, we just called it R sub S. With bonds, way back in our bond chapter, we called it R sub D. But the investor's required rate of return will have an inflation premium built in there. By the way, no individual should ever buy preferred stock. The only companies that issue it are regulated monopolies. They've sort of got a little niche set up for that market. But the only people that invest in preferred stock are not people, they're corporations. The reason is corporations get a monstrous tax break. If like Microsoft bought the preferred stock of Energy and Energy paid dividends to Microsoft, at least 70% of that dividend income would be tax exempt to Microsoft. They get a huge tax break, which causes them to drive the yields on preferred stock down to really low levels. They'll accept low return on preferred. Microsoft will accept low return on Energy Preferred because it doesn't have to pay taxes on income, the bulk of it. But it drives the yields down way below what would be appropriate for individuals. Okay, now we need to switch. I told you there were 2 major models we're covering in this chapter. One was the dividend model. Well, we're done with it for now. The other model is called a corporate valuation model, but it's based on a concept called free cash flow. And that's what chapter 3 is all about. So before we can use the corporate valuation model, because it's based on free cash flow, we need to figure out what free cash flow is and how to calculate it. If you'll look at your slide, we won't worry about these measures right now. I've got slides for a company I'm just calling MD Corporation. There are the balance sheets for the last couple of years. There are the income statements. And to determine free cash flow, let's say we're doing this for 2020. We start by calculating something called net operating working capital. Now, working capital guys, my slides are not, my software is not working the way it's supposed to at all. It's weird. All right. Boy, it's not. Okay, I'll verbal. Better yet, I'll go to the whiteboard, maybe it'll move. Working is defined as current assets minus current liabilities. With net operating working capital, we take the current assets, but we kick out the interest-bearing items like marketable securities. Or your author may also call this short-term investments. And then when we subtract current liabilities, we kick out the interest-bearing items, notes payable. And notes payable is just another name for short-term bank loans. So if I ask you on a test, what is the difference between working capital and net operating working capital? Net operating working capital is equal to working capital when you kick out the interest-bearing items. You don't include them. As a company's level of production and operation goes up and down, a lot of the current assets will automatically go up and down. Things like cash, receivables, inventories. But marketable securities won't automatically go up and down. Likewise with current liabilities, certain current liabilities like accounts payable and accrued wages and taxes will automatically go up and down, but not notes payable. So in a real sense, what we're trying to do is get a measure of working capital that does not include financing items. It's more directly tied to operations. Now, so man, if we did this for the 2020, you notice we've got current assets of 1,037, and we've got marketable securities of 37. So we subtract that out. Looking over at the right-hand side of the balance sheet, we've got current liabilities of 310. We've got notes payable of 110, so we subtract that out. And we're left with net operating working capital of 800 million. That's our definition of working capital that's directly tied and varies with the level of operations. New concepts. We build free cash flow off of several new concepts. Then we define something called operating capital by simply adding net fixed assets to net operating working capital. If you look on the left-hand side of the sheet for 2004, fixed assets are, guys, will you guys, I'll tell you what, everybody mute your mic, please. Better yet, let me do it for a second. There we go. Did that cut down on the noise, the background noise for you guys?
Yes.
Okay, cool. I thought I was the only one hearing. Okay, so bottom line, you know how if you ask an accountant, what's the investment in the company? They give you total assets. If you ask a finance person for the investment in the company, they'll give you operating capital. That's our definition of what our net investment in operations is. We use this instead of total assets. And likewise, we have a different measure of profit. We've got something called NOPAT that stands for net operating profit after taxes. It's found by taking EBIT and multiplying by 1 minus the tax rate. Now, what is EBIT? That stands for earnings before interest expense and taxes. We're ignoring interest expense. So basically, NOPAT is, here we go. I'll see if I can write it without this thing blowing up. NOPAT is what net income would be without any debt. If the company had no debt, the NOPAT would give you net income. But just as with the assets, we tried to remove the interest-bearing items in net operating working capital, we're doing the same in our measure of profit. We're taking a measure of profit before interest expense, which is the same thing as ignoring interest expense or leaving it out. If you look at the income statement for 2020, EBIT was 300, and I didn't give it to you. Yeah, I did. Your tax rate's 40%. So we've got a NOPAT of 180. So basically we had an investment of 1,800 mil in operating assets, and we're earning an after-tax profit from operations of 180 mil. Now, finally, to our definition of free cash flow. It's found by taking NOPAT minus the change in operating capital from the prior year. And I don't even think I gave that to you, so assume, well, you could have calculated it, but let's assume this is given, okay? Last year, our operating capital was 1455 mil. This year, it's 1800 mil. So that means we had an expansion in operating assets. Of our investment in operations, we had an expansion of 345 mil. Now, in after-tax profit from that year, we earned 180 mil. So here's my question. Did we earn enough in after-tax profit to pay for the expansion? That's where I pause while that sinks in. Will the 180 million we earned in after-tax profit cover the cost of the 345 million expansion? Of course, the answer is no. But the question is, how far short were we? We fell $165 million short. For this particular year, free cash flow worked out to be negative. That's not necessarily a bad thing. If you catch a company that's growing like mad, like Amazon has been, it will likely have a negative free cash flow because it will be expanding so much every year that its profit won't cover it. So for our company, MD, in 2020, what does the negative free cash flow of 165 million mean? Well, since they came up short 165 million, they had to go out and raise it. So they had to either borrow more or sell more stock. Now, we don't want free cash flow to be negative forever, but for fast growing companies, a negative free cash flow is pretty common. All right, just for grins. You know what? When I silence all your mics, it's eerily quiet on my end. Hampton, raise your hand up to show me you're hearing me. Thank you. All right. Now, try this. Find net operating working capital, operating capital, and free cash flow for 2019. And assume that it's given that operating capital in 2018, that would be the prior year, right? Was 1405. Take a minute and see what you come up with. I thought I'd wait about 5 minutes, see if you guys can crank this out. You have to use those financial statements and the figures for 2019, prior year. Put my little Michael Jackson glove up since it didn't work. I'm still in class. My genius idea of using a glove did not work. Anybody got a figure yet? I know you can unsilence your mic to answer that question. While you're playing with that, I'm just going to peek at you. Yeah, a bunch of you still here. Let's see. What did I call those? Marketable securities or short-term investments? Marketable securities, okay. Same thing. Nah. So, assets were 810. Marketable securities were 65. Current liabilities were 220. Notes payable was 60. And that should give us, well, it doesn't give us. $585. Then operating capital. Would be net operating working capital plus fixed assets net. So that would be 585 plus fixed assets last year were 870. So that's 1455, I believe. Yeah. No pact. Would be EBIT times 1 minus the tax rate. Last year, no pat was 200. Learning something. No, I'm not. Okay. Sorry, guys, I've got a Microsoft Surface and it is misbehaving big time. There we go. 200 times 1 minus the tax rate would give us, what, 120? So then free cash flow for 2019 would be no PAT minus the change in their operating capital. No PAT was 120. Operating capital went up to 1455 from 1405 in the prior year. So they had an expansion of 50 million, and they had operating profit after taxes of 120 million. So the operating profit more than covered the cost of the expansion and left them with another 70 mil left over. So in 2019, free cash flow was positive. So how much in 2019, how much do they have to go out and raise by additional borrowing or selling more stock? None. They were able to cover the cost of the expansion just from their operating profit. So in 2020, free cash flow was negative, which meant they had to go out and borrow money. In the prior year, 2019, it was positive, which means they weren't forced to seek more outside funding. The first time I taught this was in an executive MBA class in Mandeville. And my students were all corporate execs of one sort or another. They taught this to me. They used it on their job. I was surprised. All right, you may unmute your mic for this. Does anybody have any questions? Is it making sense?
So when we work problems like these, you're always going to give us the balance sheet with the numbers for the company.
Yes and or no. I'll either give you the balance sheet and income statement, or I'll give you the figures you need off of it. Does that sound fair?
Yes, sir.
Okay. Hutch, was that you? Who was speaking? I couldn't, one of you's a ventriloquist. I couldn't see you moving your mouth. John, was that you? No? Oh, well, whoever it
No,
was.
that was Hampton.
Oh,
That was me.
good question. Hampton, your camera is where I can see your hat, which is fine. That's fine. Hey, stay comfortable. All right. Now, another concept. Before we get back to the corporate valuation model, there is another concept that ties in with all of this. We don't use it to find free cash flow, but we use it to evaluate managers. It's called EVA, Economic Value Added. In English, that shows how much the company's profit exceeded or fell short of market expectations. So for example, let's go back to 2020. Let's say in 2020, WACC was 12%. Well, what's WACC? Think of WACC. WACC stands for weighted average cost of capital. And actually, our next full chapter is all about WACC. But for now, think of this as the rate of return the market was expecting the company to earn on its operating assets. And it's found, EVA is found by taking the operating profit they actually earned and subtracting what the market thought they would earn. So for instance, in 2020, they actually earned 180 million. The market thought they were going to earn a 12% return on their 1,800 in operating capital. They thought they were going to earn 216 million. So did what they actually earned exceed expectations or fall short? It fell short, right? And that gives them a negative EVA. That negative EVA of 36 million simply means their net operating profit after taxes, their operating profit, was 36 million lower than the market expected. What usually happens to the stock price when the company announces its actual earnings are below what the market was expected? If IBM today announces earnings of 30 cents a share and the market was expecting 35, what usually happens is the stock price, it takes a dive. Now, I said that a negative free cash flow is okay. That's not necessarily a bad thing. A rapidly expanding company will have negative free cash flow, but a negative EVA, that is, forgive my simple language, that is a bad thing. It means their profit fell short of expectations. And when that happens, the stock price drops. It hurts the shareholders. Now, just for grins, again, let's look at EVA for 2019. And I'll leave some of this stuff up there. You will need, let's see if I can do this without blowing everything up. We earlier found NOPAT for 2019 was 120. Operating capital was 1455. What if you're now given that the WACC in 2019 was 10%? back in 2019, the market was expecting the company to earn 10% on its operating capital. And we already found it earned 120 on its operating capital of 1455. So EVA for 2019 would be the notepad for 2019 minus the WACC times its operating capital. Oh, this thing's going all over the place. So we had notepad of what, 120? That was our actual operating profit after taxes. The market was expecting us to earn 10% on operating assets of 1455. So it was expecting us to earn 145.5 mil. Well, it looks like it was another bad year. We fell short again by, I think that's 25.5 mil. So what likely happened to the stock price in 2019? Went down. Tell me something, if you're the CEO of this company and you have a negative EVA 2 years in a row, how secure would you feel about your job?
Not very.
Not very. I agree. Okay. Tell you what we'll do. I've got some questions at the end of chapter 3. I'll let you look through those. We can go over them later if we need to. Let's flip back now to our stock valuation chapter to where I've got corporate valuation model. And actually, I want to look at something. I may need to adjust the slides a little. Yeah, tell you what, guys, I'm going to freewheel on this, okay? What I put in your slides was a little trickier than I wanted to do. So we're going to start simple. These are going to be your notes on the corporate valuation model initially. The corporate valuation model basically says the value of operating assets is the present value of all future free cash flow. We believe that the value of a company's operating assets is found by forecasting all the future free cash flow, discounting it back to the present. Kind of like when we value a security, it's a present value of future cash benefits. Well, the free cash flow of the future cash benefits on the operating assets. And let me make a problem. Let's say we've got free cash flow. I'm going to use those subscripts I used earlier for dividends. Free cash flow, that would be for the year just ended. Let's say it's, I don't know, 50 mil. And let's say that our forecasted growth rate in free cash flow is 5%. And our cost of capital is 15. So what would be the value of the operating assets? We're going to use a model that looks a lot like your dividend model. It would be the free cash flow in the coming year divided by the cost of capital minus the growth rate in free cash flow. Remember, I told you your dividend model was actually an algebraic present value function. It would find the present value of a series of future cash flows that go forever, grow at some constant rate G. And with the dividend model, the growth rate was the growth rate in dividends. The thing on top was the dividend in the coming year. And the discount rate on bottom on the left was R sub S, the stockholders' required rate of return. But in valuing free cash flow, we're working with free cash flow rather than dividends. I'm writing very slowly because this thing seems to jump around less if I write slowly. Wait, what did I say? 5%. So our free cash flow in the coming year, and guys, I'm making this up, so bear with me. I'm getting 52.5 mil. So the value of our operating assets now would be the free cash flow in the coming year divided by our cost of capital. Again, since this is an algebraic present value function, we put all our interest rates in decimal form. So we put in our cost of capital is 0.15 and our growth rate is 0.05. And we would get a value of operating assets of 525 mil. You with me so far? Anybody? A hand?
Yes.
Cool, thank you. Okay. This is like the Texas two-step. First, you find the value of the operating assets. Then the second step is you run this through the balance sheet equation. Let's assume that this company, this is given, has total, well, better yet, let me say it this way. It's got notes payable of 50 mil. No, different number, 75 mil. And it's got long-term debt of 125 mil. Now with the balance sheet equation is assets equal liabilities plus equity, right? Accounting 101. Only we separate assets into two categories. Operating assets and really non-operating assets, which are your marketable securities. And for liabilities, golly, I hate to say. For liabilities, I'm going to use D for debt, okay? It will only be the interest-bearing debt. Because earlier, to come up with free cash flow, we subtracted accounts payable and accruals, the non-interest-bearing debt, so that's already been washed out. And it's reflected in the free cash flow, which is reflected in the value of the operations. But if you didn't follow that, just note we use the value of interest-bearing debt, and we add to that the value of equity. Let's assume one other thing. Let's assume this company's got marketable securities of, I don't know, 25 mil. So now we plug and crank. We found the value of operations to be 525. We've got marketable securities of 25 mil. Interest-bearing debt would be notes payable plus long-term debt, because those are both, notes payable are short-term bank loans, you pay interest on that. Long-term debt would be bonds, you pay interest on that. So they're both interest-bearing. And if you'll notice, we end up with an algebraic equation with one unknown. So we solve. And we find the value of equity would be the value of operations plus marketable securities minus the value of the debt. Let's see, 550 minus 200 would be 350. Now, that 350 million is what we think the company's stock is worth In fact, what we called that earlier was the intrinsic value of the stock. So let's add one more step. Let's say we're given that the company has 10 million shares of stock. So what would be our value for the stock per share? We take what we think is the value of all the stock, that's the value of the equity, and divide by the number of shares. In this case, $350 million divided by 10 million shares. And that gives us a value for the stock of 35 per share. That is what we think it's worth. That's what we think is the stock's intrinsic or true value. So if we were thinking about buying stock in this company, 35 is the most we'd want to pay. We'd like to buy it for less. But because we think it's worth 35 and no more, 35 is the most we'd pay. Are you with me on this? All right. Different problem. Just for grins, let me give you one more to try. Give me 1 second, I'm making up some different numbers. I guess that's enough of the different numbers to make up. What if we have a company and free cash flow for the coming year is forecast to be 20 mil. The growth rate is forecast to be 5%. The cost of capital is 10. Let's say in notes payable, they have $100 million. In long-term debt, they've got $200 million, and they've got no marketable securities. Calculate the value of operations. Calculate the value of equity. And then assuming this company also has 10 million shares of stock, calculate the value of the stock per share. And let's see what you come up with. I have no idea. I'm making this up as I go. Nah. We've got about 7 minutes left. I'll give you 5 to do this, and then I'll go through it in 2. Anybody got a figure yet for the value of the stock? I have no idea what we're going to get. I may have made up some bad numbers. Okay. Do I need to multiply that free cash flow by 1 minus the growth rate? If it was FCF sub 0, that would have been for the year just ended. But since that is FCF sub 1, that's the free cash flow for the coming year. Remember with dividends, you could be given the dividend for the year just ended, that's D0, or the dividend for the coming year, D1. Since this is FCF sub 1, that's the free cash flow for the coming year. So we don't have to multiply it by 1 minus the growth rate. We can plug it directly in. Cost of capital is 10%. Growth rate and free cash flow is 5. I'm getting a value of operating assets of 400 mil. So now if I plug that in, what do I plug in for marketable securities? Zip, right?
Well,
Long-term debt and notes payable add up to, notes payable are 100 million, long-term debt 200 mil. If we solve, I think the value of equity works out to be 100 mil, doesn't it? And then to get the value of the stock per share, we take the value of the equity, which is 100 mil, divide by the number of shares, and I stayed with that 10 million shares. And our estimate of the value of the stock is $10 per share. That's what we think it's worth. Listen to me carefully. In your slides, slide 36 starts the discussion on the corporate valuation model, right? Ignore, you'll love this, ignore all of the slides after that point. I hit you with a set of slides that had trickier problems than I meant to. So use this information I have put on the whiteboard ever since I brought up corporate valuation model. Use that as your slide information on the corporate valuation model. Don't worry about what you see in slides. Well, I'll put you this way, slides 37 through 47, you may ignore. There are a couple of slides at the end I would like to cover, but we'll do that next time. What I plan to do next time is just go over some problems. But just in case, please bring your slides to chapter 10, cost of capital. Now this thing will be recorded. I'll get the recording late this afternoon or tonight, and I'll post it to YouTube by tomorrow afternoon. That recording will be posted to the Moodle webpage. Any questions before we adjourn? I know it's a lot and stuff you haven't seen before, but that's a good thing. Well, the stuff you haven't seen before, that's a good thing. I don't know if the lot part's good. If you have no other questions, we'll call it a day. Anybody have anything else before I sign off? All right, you guys have a good day. Stay safe.
Okay, good day.